SoFi is one of those battleground stocks with strong opinions from both the bull and bear sides, and you just don't know where the stock is heading next. But recently, the stock rallied 80% on the news that the student loan moratorium is about to end. So, is SoFi stock at $8 a share a buy today? My name is Riado, and this channel is all about finding the companies of tomorrow. In today's video, we'll be covering SoFi. We'll take a look at its financials, valuation, risks, and more. And if you stick till the end, you'll find out what I'll be doing with the stock. With that said, we got a lot to cover. Let's not waste any more time and jump right into the analysis. Social Finance, or SoFi, was founded in 2011 by 4 students of the Stanford Graduate School of Business. The 4 students wanted to build a platform that provided more affordability in terms of student loan financing, so they launched their pilot loan program to approximately 100 students for a total of $2 million, which was entirely funded by 40 Stanford alumni. This experiment proved to be successful, and SoFi went on to raise more capital from banks and outside investors, which allowed the startup to expand to other schools across the country. So everything was going great for the company until in September 2017, when former CEO Mike Cagney stepped down from the big job due to allegations of sexual harassment, which pretty much damaged SoFi's brand reputation. Fortunately though, just 4 months later, SoFi hired the man that made SoFi today. So Anthony Noto joined SoFi as the new CEO, and he is probably the perfect person to lead the fintech company. He was the former COO and CFO of Twitter. He was also a former managing director and partner in Goldman Sachs, and he was also the CFO of the NFL. Put simply, Noto has really strong leadership skills, and he has excellent business and financial acumen to lead SoFi out of the dark. And so he did. Since Noto became CEO, SoFi launched its financial services and technology platform to complement its core lending business, as well as went public through a SPAC merger in 2021. In a nutshell, SoFi helps members get their money right by building a platform that serves as a one-stop shop for all things finance, allowing members to borrow, save, spend, invest, and protect their money. So at a high level, SoFi operates 3 business units. The first is its flagship lending business, which offers personal, student, and home loans through an in-app digital borrowing experience, which also supports the entire transaction cycle, including credit application, underwriting, approval, funding, and servicing. For example, students can apply for a student loan with varying loan sizes and repayment options at competitive rates with no application or origination fees. Next, SoFi's technology platform offers enterprises technology products and solutions such as digital banking, card issuing, payment processing, and more. This is made possible through Galileo, which SoFi acquired back in May 2020 for $1.2 billion. And basically, Galileo is a banking as a service that provides the technology platform for financial and non-financial institutions to power their fintech ambitions. Some of Galileo's clients include Dave, Chime, Robinhood, Toast, and of course, SoFi. Galileo's value proposition is also amplified by its recent acquisition of Technisys, which is a cloud-native digital and core banking platform. Finally, SoFi offers financial services and products through its mobile app and website, and this is the most consumer-facing product that SoFi offers. This includes SoFi Checking and Savings, which provides up to 4.2% APY, which is over 10 times the national average, as well as up to $2 million of FDIC insurance. So this makes one of the most attractive high-yield savings accounts in the United States. Then there's also SoFi Invest, which is a mobile-first investment platform, SoFi Credit, which allows members to earn rewards, and SoFi Protect, which offers insurance products from third-party providers such as Lemonade. I won't go through all of them, but these are just some of the financial services that SoFi offers. But ultimately, through its 3 business units, SoFi aims to be the one-and-done platform for people to manage their finances, helping them to reach financial independence to realize their goals and ambitions. So moving on, I see 3 competitive moats for SoFi, the first one being technology. So SoFi offers one of the most vertically integrated offerings in the fintech space today, and this is offered through their 3 business units. Members can manage their finances all in one app, including their loans, deposits, and investments. SoFi also has Galileo, which offers the back-end financial and banking infrastructure for other institutions, which people claim to be the AWS of fintech. And SoFi also also has the bank charter, which enables SoFi to act as a bank for both its members and partnering businesses. As far as I know, the only competing platform that comes close to SoFi is probably Block, but Block doesn't have the banking as a service component that Galileo offers. So technology-wise, SoFi has a more complete stack among competitors, which offers a stronger value proposition for everyone. And having a vertically integrated technology stack means that SoFi is able to collect more data at each stage of the product or service, which allows the company to create better overall customer experience. And that data advantage, and through offering better products, SoFi is able to gain cost advantages moats, and SoFi calls this the financial services productivity loop. So basically, by offering best of breed products, more members will eventually join the platform, and slowly but surely they will start to use more products within the platform, which drives superior unit economics. So as CEO Anthony Noto mentioned in the earnings call, that cross-buy allows SoFi to bring in that second product with no customer acquisition cost, which has a huge impact on unit economics. And with better unit economics, SoFi passes on the savings to customers, which amplifies value proposition. In addition, the banking charter that SoFi achieved in February last year allows SoFi to lower its cost of asset-backed financing by utilizing customer deposits at SoFi Bank to fund its loans. At the same time, SoFi can offer lower interest rates on loans and offer higher interest rates on deposit accounts, and that is why customers are flocking to SoFi. Finally, SoFi has high switching cost moats. Again, SoFi is the one-stop shop for all things finance, which makes it incredibly easy for consumers to manage and track their finances, and it will be difficult for members to switch to another provider if, let's say, they have already used SoFi Loans, SoFi Checking, SoFi Invest, as leaving the platform would mean finding a provider that could do everything that SoFi offers, which I think is non-existent today. So I think it's better to have one platform to manage all your finances rather than having multiple accounts from different providers, and as members use more SoFi products, the harder it is for them to leave the platform. In addition, Galileo's banking as a service offering provides the critical infrastructure for enterprise customers, which is essential to their operations and ultimately their success. At the same time, through SoFi Bank, SoFi can also act as the sponsoring bank on behalf of these enterprises, which makes it even more convenient for them to do business with SoFi. So again, switching providers will be a pain in the ass for them. Now that we're done talking about what the company does and its moats, let's take a look at its financials. So GAAP revenue for 2022 was $1.6 billion, which is up 60% year over year, while adjusted revenue was $1.5 billion, which is up 52% year over year. And the difference between the two metrics is that adjusted revenue exclude the fair value changes in SoFi's lending segment, as they are non-cash charges, so keep that in mind. Moving on, Q1 GAAP revenue was $472 million and adjusted revenue was $460 million, with both growing at 43% year over year. As you can see, growth has been really strong ever since the pandemic started, and although growth has decelerated, a 40% growth is still very impressive given tough year over year comps. However, expect growth to continue to decelerate as the company grows over a larger base. Nonetheless, strong growth was primarily due to record revenue in all three of SoFi's business segments, which we'll dive deeper next. The lending segment is SoFi's bread and butter, generating 72% of revenue in 2022, and although lending revenue concentration went down from 75% in 2021, lending revenue concentration could accelerate in the next few years as the student loan moratorium is set to expire later this year. Nevertheless, 2022 lending GAAP revenue and lending adjusted revenue was both $1.1 billion each, growing 54% year over year and 45% year over year respectively. On the other hand, Q1 GAAP lending revenue was $337 million and adjusted lending revenue was $325 million, both up 33% year over year. Growth in the lending business was due to higher loan balances, higher average yields, and higher net interest margin, as well as strong demand for personal loans, offset by lower student loan and home loan originations. As you can see, growth exploded during the early days of the pandemic and then decelerated meaningfully. However, 20 to 30% growth is still very strong despite the student loans business experiencing a major slowdown due to the CARES Act pausing all federal student loan payments since March 2020. As you can see, home loans originations took off in 2020 and early 2021 as ultra-low interest rates increased demand for home mortgage applications applications and mortgage refinancing. However, ever since the Fed hiked interest rates, demand for home loans have decreased significantly as home affordability becomes too unbearable for many. At the same time, management also mentioned that the company is undergoing continued transition of home loan fulfillment partners, which is why there's a big drop in home loan originations over the last few quarters. However, the company is in the process of integrating Windham Capital Mortgage, which it acquired in April this year, and so we should see improvement in the home loans category soon. On the other hand, both personal loans and student loans originations crashed in 2020, but personal loans originations bounced back quickly while student loans continued its downtrend as the student loan moratorium was extended multiple times. As you can see, student loan originations fell from $2.1 billion in Q1 of 2020 to just $525 million in Q1 this year. Fortunately, the personal loans category has been growing so rapidly that it's essentially carrying the entire lending segment with nearly $3 billion of personal loan originations in Q1, which is up 46% year over year. Turning to its technology platform segment, here I've included its revenue and the number of accounts over the last few quarters. Tech platform revenue consists of revenue from Galileo, which was acquired in Q2 of 2020, as well as Technisys, which was acquired in Q1 of 2022. As you can see, tech platform revenue was $350 million, which is up 62% year over year. On the other side, Q1 revenue was $78 million, which is up 28% year over year. Growth was due to the additions of new clients and growth at existing clients, but as you can see, there's a sharp deceleration in the last few quarters, and this slowdown is in large part due to slowing account growth, which on a quarter-to-quarter basis dropped by 5 million accounts in Q1. CEO Anthony Noto mentioned that this is due to a partner that moved out of the platform, which is why accounts dropped in Q1. The CFO also mentioned that while accounts dropped quarter over quarter, accounts still grew year over year, which drove the growth in Q1, and the company also signed 5 new clients in Galileo, and through Technisys, SoFi finished the task of moving every client to the cloud with 100% of transactions now migrated. As you may or may not know, the transition from on-prem to the cloud means that revenue will now be recognized ratably over the length of each contract with clients instead of upfront, which is why we see a slowdown in tech platform revenue. The CFO also mentioned that the sequential drop in revenue and contribution profit in the tech platform segment were due to seasonality and the timing implications from shifting focus to larger customers. So the bottom line is that the tech platform is still growing and is going through some structural changes. The only red flag that I see is the drop in accounts, because if you look back here, accounts dropped by 5 million quarter over quarter, but SoFi also added 5 new clients, so this partner that left the platform had more than 5 million accounts and possibly 10 million accounts, so maybe we're seeing some cracks of SoFi's switching cost mode, so that is something to be aware of. Moving on, financial services revenue in 2022 was $168 million, which is up 189% year over year, and in Q1, revenue in the segment was $81 million, which is up an impressive 244% year over year. The robust growth that you see here is due to strong member growth and product growth as the company continues to innovate with new and relevant offerings, features, and rewards for members. The CFO also mentioned that improved monetization also drove growth in the segment, with annualized revenue per product increasing to $45, which is twice the $20 in the prior year and up 15% sequentially from $40. So this is really great to hear. So as mentioned, strong financial services growth is due to strong member and product growth, and as you can see, members grew 46% year over year to 5.7 million in Q1. On the other hand, lending products have also been growing steadily at 24% year over year in Q1 to 1.4 million products, even despite the home loans and student loans businesses struggling. And as expected, financial services products continue its strong growth, although it is decelerating, but this is expected due to tough year-over-year comps. And as of Q1, financial services products was 7.1 million, which is up 51% year-over-year, and overall, total products grew 46% to 8.6 million. But it's worth mentioning that total products refers to the cumulative number of products used by members since its inception, whether or not the members are still registered for such products. So if a member opens a checking account and then 1 month later they close the account, it will still be counted in the total products metric. I don't like the total products metric as it counts inactive members that sign up for a particular product, and it's hard to tell how many products are actually active and how many are dormant. So I would love to see management update this metric in the future. Nonetheless, it is still very impressive growth overall, and as you can see, the ratio of financial services to lending products continue to grow with each passing quarter, which shows high engagement within the platform and more members using multiple SoFi products. All in all, SoFi is showing really strong growth across all its business segment, especially its financial services segment, and the company is not even firing on all cylinders as the student loan moratorium puts pressure on the lending business, and the home loan business is also going through some challenges of its own, namely the transition of its fulfillment partners. So once the student loan moratorium ends and once the Wyndham Capital mortgage integration is complete, we could see an acceleration in SoFi's business. That said, the fact that SoFi can grow at such a high pace despite the different challenges it is facing right now says a lot about the quality and execution of the management team. So overall, really strong performance by SoFi, but there's also reasons to believe that SoFi's growth story is still in its early stages. Here, I've included some things that management mentioned during the earnings call and conferences that they recently have, which paints a good picture of SoFi's market opportunity. According to CEO Anthony Noto, SoFi's TAM for the student loans business is about $200 billion, which consists of interest rates in the high 6s and high 7% range that was issued going all the way back to 2009, and people would want to refinance that at a lower rate, and SoFi can provide that. Next, CFO Chris Lapointe also mentioned that SoFi has a market share of 8.2% in the personal loans category, which is up from 5.8% last quarter and 5.5% a year ago. So SoFi is rapidly gaining market share, and SoFi still has lots of opportunity to continue gaining market share in the personal loans category. And lastly, CEO Anthony Noto mentioned that the company averages roughly about 1.5 products per member, and SoFi has so many products in their portfolio, and I see this number eventually reaching at least 5 at maturity, which could lead to strong unit economics and network effects for the company. So just by looking at these comments from management, we can see that there's a lot of room to grow for SoFi. And not forgetting to mention, the embedded finance market, according to PwC, is expected to grow from $54 billion in 2022 to $248 billion by 2032, which is going to be a major tailwind for Galileo. Legacy financial institutions will need to revamp their legacy banking infrastructure to provide the best digital banking experience for consumers, and Galileo, as the AWS of fintech, could be the banking as a service provider for these institutions. This is part 1 of a 2-part video, and in the second part, I talk more about SoFi's profitability, balance sheet, and valuation. And so if you're interested in watching the second part, you can click in this video right here, or you can find the link to part 2 in the description below. Also, if you find value in this video, I would appreciate it if you hit the like button and subscribe to my channel. Thank you, and I'll see you guys in part 2 of the analysis.